looking for underlying signs. The markets are desperately looking for signs that are not coming. The union budget is still over a week away, and that could be the next possible event, at least from a market point of view, but one that could disappoint as well, particularly if there are no major tax stops, particularly on individual taxes. On the other hand, most institutional investors, particularly foreign institutional investors, are still alluding to high valuations and putting their sell orders where their mouth is or was. Given all of this, what are the underlying signals and what sort of phase are we in? I spoke with Ambareesh Baliga, veteran market analyst. I began by asking him how strong the selling pressure was.
Overall signal which is coming from the markets is that possibly it's time for the markets to correct. And that's what we have seen in the last close to 2.5, 3 months. Again, this is because of the sort of macro numbers which have been coming, which have been nothing too great. Earnings of Q1 was a bit disturbing, but we thought it was a blip. Q2 confirmed that there is a slowdown, there is a margin pressure across the sectors. And Q3, whatever we are seeing, clearly again reconfirms that. I think all these things put together, have put their pressure on the market, despite the fact that retail money has still been coming. If you look at December was record for the SIPs as far as mutual funds are concerned. But then whatever is happening globally, because of which we are also been seeing that the FII money outflow has been quite strong, because of which the retail money is not been able to make that effect what we saw in the last close to 3.5, 4 years. That is what was pushing the markets up. So today we are in a situation where most of the retail investors are finally feeling cautious. There is a bit of a panic I can notice in that space. And like most of the stocks or sectors where they've invested, they've been losing money. For the last 8 to 9 months, although the markets have been falling for the last 3 months, retail investors have been losing money for the last 8, 9 months at least. Because they've been investing in those sectors where actually moving up quite sharply, for example, defense and railways. And that's where we saw a major cut in 2024. So most of the portfolios have been in the negative. In the past, they've been following this thing that whenever the market falls, it's a good time to buy. And that played out very well for them all through. But this time, it's not playing out. Every extra rupee you're putting in, you're getting 10 paisa, 20 paisa. You're happy you're putting in more money. So we're in a virtuous cycle. But now what's happening is every rupee you're putting in, you're getting back 90-95. So because of which, fresh money will slow down. And I'll not be surprised if you see the January numbers. We still not been declared, but when the January SIP numbers come, we could be surprised with a lower number. I'm not saying negative, but I'm talking of a lower number than what we have seen in the past. So that could be another trigger for the markets to start correcting further because we were depending on the retail money coming in. So overall trend which I notice now is that we are in that downswing. But downswing does not mean that it will be a one-way down. We'll see those bounce backs like in between. So we should see some short rallies. For example, I'll not be surprised if we see a pre-budget rally. Normally we see that. And after this sort of a correction, a normal pre-budget rally can be expected. But if you're talking over the next 2, 3, 4 months, I see the markets at a lower level. If you ask me, are you looking at a crack or a crash? No. Okay. If it asked me 4, 5 months back, I would have said, yes, possibly you should see a crash. But then markets have come down like decently well, but not very, very sharply in short time, which is what we call crash. And even going ahead, I don't see that happening. But then it would be painful for a lot of investors because they've been used to instant gratification. That's not going to happen, at least in the near future.
Got it. And I'm going to come to a theme question in a moment. But before that, so the belief all this while was, and that because we've seen such strong domestic flows, that would not just counterbalance, but outweigh foreign portfolio selling.
Absolutely.
So why is that not happening then?
No, because the amount of outflows of FIIs is decently large.
So we're looking at $7 billion this month, but that includes bonds. Yeah.
Yeah. And at the same time, it is not just the retail money through the mutual funds which was pushing the markets up. It was also the retail money which is coming directly into the markets. And that's the first thing to stop. And I'll not be surprised if it's already reduced quite a lot in the last 2, 3 months. Because, again, you look at the sort of investments they would have made in the last 7, 8 months. SIPs of the last 7, 8 months would surely be showing losses as of now. So, a couple of months you can still manage. But beyond that, you start questioning yourself. Am I doing the right thing? Is the fixed deposit better than investing in equity at this point of time? All those questions come up.
So what is the theme or the themes that have somewhat survived this downswing, as you called it, so far at least?
If you look at the theme which was there in the last 2 years, it was basically defense and railways. But that theme, we saw that thing getting burst around the middle of 2024. And then after that, we've seen a major correction. I think most of the stocks have corrected 35, 40, even 50% in some cases. But the one theme which has started doing well in 2024 was that electronic manufacturing services, third-party manufacturing. Like we have about 12 to 15 stocks in this space. One of the majors is Dixon. But now lately what we have seen is that the performance, although is good, but performance is not keeping pace with the analyst expectations. Because these stocks have become multi-baggers in the last about a year or 15 months. So, although that theme was running for the last couple of months very well, but I'm starting to see cracks in that theme right now. So maybe what we've seen in defense and railways happening in 2024, I think we'll see that happening in this theme in 2025.
Is there something which looks like, is in some ways reflects the passing of an era? Like, every cycle sees some stocks or some themes which become stars and then they disappear. If not for a long time, then sometimes even forever.
As of now, I don't see any such theme which will possibly disappear forever. But there are a couple of themes which can possibly play out decently well going ahead. Those themes haven't done too well in the recent past. When I say a recent past, possibly the last couple of years, but I think those themes should start doing extremely well going ahead. And two of those themes are, one is consumer, because consumer story has been going through a very bad phase, especially in the last couple of quarters. There's been an urban slowdown. Rural hasn't really picked up as expected. But that theme possibly can start playing out in the next 2 or 3 quarters. The other one is specialty chemicals, which played out extremely well in 2021 on China Plus One story. I think that should play out now going ahead. The difference between then and now is that most of these companies have expanded capacities. Now, quite a few of them have world-class facilities, world-class capacities. So the China Plus One can actually play out extremely well now when there would be trade sanctions against China, those trade barriers.
Thank you so much for joining me.
Thank you. Always a pleasure.